Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, I'm going to talk about the biggest tax mistakes people make and how to avoid them. But as always, before we get into the episode, the free advice for the week. Never get stuck in thinking conventionally. That is when you lose. Now that we've got that free piece of advice out of the way, it's time to get into today's episode. And as I was thinking about today's episode, it immediately jumped to my attention that this is a much more in-depth episode than most realize. So this is how I'm going to break down today's episode to give you everything you need to know in the most efficient manner possible. So I'm going to go through the 3 stages of wealth, which is accumulating assets, preparing for retirement, and then decumulating assets, which is in retirement. I'm also going to break down each stage by levels of wealth, which I will classify as lower income, middle class, and high net worth. And then lastly, after each mistake, I will tell you how to avoid that mistake. So with that, buckle up because this episode is a loaded one. So the biggest tax mistakes by stages of wealth. The first one, accumulating assets early to mid-career. Let's start with the lower income households. The first mistake, not capturing refundable credits. Too many actually, lower income households miss major tax credits like the earned income tax credit and child tax credit simply because they don't know that they qualify. So how do you avoid that? You can use a professional tax preparation service or an IRS-free filing, or you can just verify eligibility for all refundable credits annually, like at the very, very least. Number 2, failing to save in tax-advantaged accounts. So many workers rely solely on taxable savings and miss long-term compounding advantages from accounts like a Roth IRA or a Roth 401k if you have the ability to use it. So how do you avoid that? Even by contributing a small amount of money into your Roth accounts, again, if you've got a Roth 401k or a 401k with a Roth eligibility portion, you're going to want to use that first. If you don't have that, a Roth IRA. And keeping on with the theme, you want to prioritize Roth contributions while you are in a low tax bracket. And the reason is really, really simple. If you are in a low tax bracket today and that money compounds over time and you've invested successfully, you don't want to simply compound your money simply into a higher tax bracket later in life, in this case, retirement. You want to avoid the highest tax possible by contributing with after-tax dollars in your lowest tax bracket, let that grow tax-free. And then in retirement, all of that money is taken out tax-free from your Roth account. So the third mistake, early retirement withdrawals. So cashing out a retirement account early, that's going to trigger income tax and penalties. And to give you an idea, if you have $10,000 coming out before age 59 and a half, and let's just say you're in like the middle of the road tax bracket for easy math. If you combine from that $10,000, the tax bracket you're in, the 10% penalty, and some administrative charges if it's a retirement account, like a company 401k, that $10,000 suddenly turns into $6,500. That's not great. So how do we avoid this? Well, you avoid withdrawing from your retirement accounts before 59 and a half, and then you use your emergency funds instead. Now let's talk about the middle class households here. One of the biggest mistakes I see is missing employer retirement matching contributions, not contributing enough to capture the full match in a 401k. It's effectively leaving free money on the table. So how do you avoid that? Always make sure, to the best of your abilities, you contribute at least enough to receive the full employer match. The second mistake I see time and time again, this goes off of what we were talking about with the lower income families as well, poor Roth versus traditional planning. Many savers default to traditional accounts when they may very well benefit more from Roth contributions. So how do you avoid this? There's a couple ways to go about it. You want to evaluate your current versus projected retirement tax bracket annually, but then also you want to use your Roth during your lower tax years. Now, that sounds almost identical to the lower income conversation we had just moments ago. And you're probably thinking, well, with middle class, is it a little bit more complex? It is, because now you have to weigh the options of, all right, well, even though I may be middle class today, if I keep compounding my wealth, I very well may be in a higher tax bracket. Or with my spending, I actually may still be in that middle tax bracket, which is fine, because when you get to retirement, it's just a different game. It's not like you need to control. The primary goal isn't to save as much because you've retired. The primary goal is to live off of your savings, with tax efficiency always at the forefront of your mind. So again, slight nuance difference, but you need to understand that. So the third mistake I see middle class making in the accumulation phase, underutilizing health savings accounts. Many people treat the health savings accounts, or HSAs for short, as a spending account rather than a long-term tax shelter. So how do you avoid that? You need to max those contributions annually. And then you also need to invest the HSA balance for long-term growth. In I believe it's either next episode or 2 episodes from now, we are actually going to get into everything you need to know about HSA. So I don't want to, I don't want to hold this episode down by just diving in too much to that, but just know, if you have a high deductible health plan, which means you would be HSA eligible, because you have to have that. If you have the ability, you got to use it. Now let's get into the high net worth households. And these are the mistakes I see all the time. First one, a concentrated stock position. Many employees or founders often accumulate large positions in a single company's stock, and that creates major risk, but specifically tax risk, when you want to diversify. So how do you avoid that to the best of your abilities? Number one, gradually diversify holdings through tax efficient sales. And then 2, use strategies like charitable gifting or even exchange funds, which I'm not going to get too into the weeds of exchange funds. These are not exchange traded funds. Exchange funds are a tool out there where you take your stock, you exchange it into the fund, and then you actually have a diversified portfolio. And what these companies do is they take other concentrated positions from other people and they build a portfolio that way. That way it minimizes the overall risk of the concentration of the holding that you have. The second mistake I see high net worth people make while accumulating assets is ignoring tax loss harvesting. So wealthy investors often fail to systematically harvest losses to offset gains. And how do we avoid that? Pretty simple, honestly. Just conduct an annual portfolio tax loss harvesting review. And what I like to do within my practice is, because if you do it too early in the year, it's a moot point, because if you're doing this in March or April or May, you don't know what the next half of the year is going to look like. No one knows. So I like to look at the very earliest October, but ideally November is where I get all of that done for my business. And the reason for that is, yeah, there could be some surprises that come in December, but the year's basically over. And so you've got a really good idea of what you're going to get, what you're going to be able to offset. I don't want to go too off script here, but there is one thing that is worth noting. Regardless if you're high net worth or just everyday individuals, don't get so hung up on tax loss harvesting or selling stock or whatever investment you have just to lock in a loss. Because sometimes when you do that, if you want to buy it back within 31 days to avoid the wash sale rule, which that's beyond the scope of this episode. Sometimes when people do that, the stock skyrockets back and it never comes back to that value that you sold it at. So just be aware of that. And then also, sometimes it's okay paying a little bit of tax. Trust me, I am a huge fan of not having to pay if I can control it. But even with that, you got to take your lumps. So the third mistake I see people make, especially the high net worth side of things when it comes to accumulating assets, poor entity structure for business owners. So again, I'm not a CPA, so I'm not giving any tax strategic advice on that front, but I have seen many entrepreneurs operate as sole proprietors instead of evaluating a tax efficient structure, which is a massive, massive no-no for a number of reasons. So how do you avoid it? Really, really easy. Chat with the CPA and just ask them, hey, what should my entity structure look like? Should it be a sole proprietor? Should it be a partnership if you have other partners in the business? Should I be an S corporation or an LLC or a C corporation? And your CPA or your enrolled agent will be able to guide you accordingly. Now let's talk about the pre-retirement years. And let's start with the low-income household. So the first mistake, claiming Social Security too early. Filing early significantly reduces lifetime benefits under the Social Security system. So how do we avoid this? Really simple. Delay benefits if possible to increase those lifetime payments. Now, for Social Security, it works very, very simply. The earliest you can take it to 62, the latest you can take it to 70. Between 62 and 67, it grows at about 5.5% per year. And between 67 and 70, Social Security grows at 8% per year. So to translate that, if you waited from 62 all the way to 70, by the time you get to 70, you will have 50% more per month from Social Security as opposed to taking it earlier. This isn't going to get into a Social Security strategy. It's just something you need to be aware of because it's one of the easiest guaranteed wins you're going to get. The second mistake I see people make, ignoring catch-up contributions. So many people over 50 miss extra contributions allowed into your retirement accounts. Really, regardless if it's your company retirement plan or your individual retirement account. So how do you avoid that? Simply maximize that catch-up contribution to your retirement plans after age 50 if you can afford to do so. Now, middle-class household mistakes I see a lot. Number one, no Roth conversion planning. And this actually dovetails into high net worth as well. Many households enter retirement with only tax-deferred accounts. So 401k, IRA, pre-tax money. So how do you avoid that? You're going to want to perform partial Roth conversion strategies in lower income years before retirement. And we could also talk about while being in retirement. The second mistake I see, not planning for RMDs, required minimum distributions. So the good news is if you've saved up all of this money pre-tax, well, you're going to be good on the retirement side of things. The bad news is large tax bills can and probably are going to occur once you hit RMD age, which as of today is about 73. And depending on how young you are, it's probably going to jump up to 75 by the time you get there. But by 73, you have to start taking distributions from your individual retirement account. And it's about 4% of the total. And then the percentage increases slightly over the years. So how do you avoid the tax issues with that? You're going to want to model future RMD impacts during your 50s and early 60s. And or when you are in retirement, I know this is pre-retirement, but once you're able to calculate how much you need on a monthly basis, and you balance that with, for most people, the standard deduction, which is huge right now, and you might get some mortgage interest deduction if you still have a mortgage in retirement, or if you live in a state that has a state income tax, your state and local tax deductions have gone from 10 grand to 40 grand. You could save a boatload in the long run by converting the difference of what you've actually taken out of your retirement account up to that next tax bracket in converting it to Roth every year. Because then by the time you're 73, ideally, your individual retirement account money, your pre-tax money is so low, again, relative to when you started this, that your RMD is hardly anything, which means you're taxed at basically nothing. The third mistake I see middle class make while they're about to retire is ignoring the Medicare tax planning. So retirement withdrawals can increase premiums under Medicare income thresholds. That's not great. So how do you do that? Very simple. Manage taxable income to stay right below the IRMA thresholds, the IRMAA, okay? Now let's get into the high net worth households. So the first mistake I see all the time, more than I'd like, in terms of being, high net worth before retirement, ignoring estate tax exposure. So large estates may, or in some cases will, face federal estate tax under the federal estate tax rules. So how do you avoid that? You can do a number of things. You can use, and again, I'm not an attorney, so I'm not giving legal advice, but this is not my first rodeo. You could look into utilizing various trusts, gifting strategies, lifetime exemption planning. One thing I do have to note on this is, again, I'm in Washington State. And I say that because Washington State has a state estate tax. So for the majority of those listening, federally, the federal limit is 15 million and above. And I get it. Most people will never touch that. That's fine. That's one less thing you have to worry about. And what that means is for 15 million, anything above that, if you do zero planning, 40% of every dollar over 15 million will go back to the government. That first 15 million is tax-free to heirs. Washington State's estate tax is $3 million. And again, a lot of people will probably not get to 3 million, but I'll tell you, there's a lot more at 3 million than 15. And so there are a ton of strategies that you can use with trust gifting, lifetime exemption planning, also maybe like living in another state to remove the state estate tax issues. Just be aware of that. Because again, it's a huge mistake that people make. The second mistake I see, not planning charitable giving strategically. So many wealthy households donate inefficiently. And how can you avoid that? Well, there's a number of ways, but the easiest one is to either take appreciated stock, if you have it, or investments in general, and you're not necessarily going to need it to live because you have plenty elsewhere. You could set up a donor-advised fund, which it's a vehicle that is out of your estate's name, but then you can still gift to a charity or charities of your choice. You also get some deductibility with that. I see this a lot. So for clients that are, let's say you're charitably inclined and you run a business and you're about to sell a business, or let's say that you have a sale of an investment and it's going to cause a lot of pain in the tax department. What I've seen a lot of people do, and I've actually done this in my practice a decent amount. If you sell a business, I'll ask a client, hey, how much do you want to give to this charity? Assuming they're charitably inclined. How much you want to give every year? And they'll tell me what that number is. And then I just work backwards. You set up a donor advised fund with the appropriate amount of money that will pay that charity over that period of time. But then you get that huge lump into that donor advised fund and you get a fat deduction in that year, which will mitigate their tax situation from the sale of their business dramatically. And appreciated stock, it's something where, if you bought it for basically nothing and it's grown and grown and grown, you could gift that stock to that charity and not only get a deduction, but then you've no tax on the liquidation, because then the charity liquidates it. And because of 501c3 nonprofit rules, they get it for tax free. So kind of a cool little tip. Third mistake I see, large pre-tax retirement balances. So too much wealth in pre-tax retirement accounts creates larger tax bills later on. Now, in and of itself, that's not a mistake now, but you got to think about it in retirement. And this goes back to the middle class issue that we spoke about. You want to gradually diversify into Roth monies with the pre-tax monies that you have. And so when you get into retirement, let's say that before you retire, you're in the 37% bracket. Well, you're going to want to contribute pre-tax. Then when you account for how much you need on a monthly basis to live in retirement, you are in the 12% bracket. Okay. Well, you take 37 minus 12. I just made you 25% in taxes you'll never pay. Great. But it gets even better with that. So let's say we look at your situation and we go, well, you're in the 12% bracket up to this dollar amount. And let's say that you're taking married file jointly. Let's say you're taking, I don't know, $90,000 out a year in your 60. You and your spouse are 60. Well, the first 32,000 of that, just call it 30, is tax-free because of the standard deduction, assuming you take that. So really out of that 90, you're only taxed at 60. And if I remember correctly, the next tax bracket's up to $100,000. So for the next decade, you could take 40 grand in that 12% bracket threshold and just convert it to Roth. And actually, let me take that back. You could even go up to 73. And so by the time you get to that point, you've basically, yes, you've paid 12% on that difference, but 40 times 10, that's 400 grand. You compound a lot of that. You could have $700,000 that's now compounding tax-free, and you avoided it in a really low tax bracket, even though you are worth a lot of money. So we're going to take a quick commercial break. And then when we come back, we're going to talk about the final aspect, the decumulating wealth in retirement by household worth. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. We are going to get into the final stretch, which is decumulating wealth in retirement. Because we've talked about accumulating, we've talked about getting ready for retirement, the hump, if you will. And now we're going to talk about what we do and all the mistakes I see people make of decumulating wealth in retirement, starting with the lower income households. So the first one, triggering taxes on Social Security. So up to 85% of Social Security benefits may become taxable with poor withdrawal planning. So how do you avoid this? It's actually pretty simple. This is one of the more simple ones. Just coordinate the withdrawals between taxable and retirement accounts. So again, with standard deductions, the first, if you're married, filed jointly, 32,000. I'm just going to use round numbers because it's like 32,200, but 32 grand is basically a write-off. And then when you are 65 and older for the next couple of years, it's up to 47,000. And I say that because let's assume you're not taking your Social Security yet. Well, you could take up to 47 grand, assuming you're over 65, from your retirement accounts. And due to the standard deductibility and the write-off, if you will, it's a wash. And so it's really taxed at zero. Now with taxable money, it works a little different because if you have an investment and you liquidate it after 1 year and 1 day, it is taxed at capital gain. So between $0 and $90,000 approximately, married, filed jointly, capital gains are taxed at 0%. So if you're over 65 and you have IRA money and taxable money, and you take 47 grand out from your IRA, and then you take $90,000 out from your taxable money, guess how much you're going to pay in tax? 0. And the reason why I bring this up with Social Security, if you're delaying Social Security, not only are you compounding that guaranteed compounding rate, because that's how Social Security works, you're also mitigating the tax benefits, because by the time you turn on Social Security, let's say that you've taken a lot of money from your IRA, and so you don't have as much ordinary income coming your way, your Social Security could be taxed at almost nothing, which would be great. So the second mistake I see people make, and this is the lower income field in retirement, withdrawing from the wrong accounts first. And we just talked about this a little bit, but improper sequencing can increase lifetime taxes. So just follow the tax efficient withdrawal order. And this also goes back to converting even IRA money to Roth money if you even need to. So middle income or middle class households, the first thing I see, huge mistake, ignoring capital gain brackets. And again, this is similar to what we just went over for lower income, but it is going to be a little bit more sensitive. Just by definition, middle class probably has a little bit more money. And so you just need to be more aware of the tax side of things. And how do you avoid that? You can harvest the gains strategically during your low income years. The second mistake, failing to plan for the widow's penalty. So after a spouse dies, the surviving spouse often moves to a higher tax bracket because single versus married, filed jointly, there's a difference. So how do you avoid all of that? That's where you accelerate the Roth conversions before the first spouse passes away. And you've heard the Roth conversion strategy a lot in this episode, and it may sound redundant. And in some cases it is, like on its face, but the different scenarios are completely different, but it all comes back to converting strategically. The third mistake is poor RMD management. So we talked about this a little bit before the commercial break. Large distributions later in retirement can spike your taxes. So how do we avoid all of that? Just spread the withdrawals strategically over the especially earlier years in retirement. Now, the high net worth households, actually, it sounds like first world problems, but when it comes to retirement, I see them having the greatest challenge of issues just because wealth is like a video game. And the larger you compound your wealth, sure, you're going to be fine on the income side of things. But if you don't manage tax in a state accordingly, locating your assets, you're actually going to be in some cases worse off than middle class or lower class. And I've seen that firsthand. So the first mistake I see is inefficient tax location. And what do I mean by that? Many retirees hold tax inefficient investments in taxable accounts. So how do you avoid all of that? You want to place tax inefficient assets in retirement accounts and then tax efficient assets in either taxable and or Roth IRA money, Roth accounts. And why would you do that? Well, we know ordinary income is taxed at the highest income bracket, then taxable, and then Roth is obviously that's the granddaddy. That's 0%. So if you spent IRA money first, let's call that the 25% bracket, and then you start spending taxable money, call it 15% for long-term capital gains, and then you go and spend the 0, not only are you paying less and less in tax as time goes on in retirement, you're actually further compounding your wealth, not only by growing those taxable and Roth dollars more efficiently than your IRA money, but you're also going to set up your future heirs for a tremendous benefit, which brings me to the second mistake. Number 2, ignoring step up in basis. So selling appreciated investments before you die may unnecessarily trigger taxes. So how do you avoid this? You want to use, you're dead at this point, but your estate is going to use the step up in basis rule by holding assets until death when appropriate. So I can actually think of a situation. I was speaking with a colleague of mine, and it was his grandpa sold a warehouse locally. And the grandma had passed away years ago. The grandpa, I think he bought it, 40 years ago, something crazy. And this warehouse grew from a couple $100,000 to a couple $1 million, which is wild. And if he sold it today, and let's just say it was $4 million, he would probably owe $1 million of that, maybe a little bit more in taxes. However, he's not in the best of health. So when he passes away, and let's just say one of his kids, just to make it really easy, gets that inheritance, that kid, the next day after the grandpa dies, could sell that asset, and his basis of where he started in terms of buying it was the date of his grandpa's death. So to translate that $4 million, he would liquidate it and pay 0 in tax. That's a huge, huge, huge deal. Now, third mistake, no legacy or gifting strategy whatsoever. Waiting too long to gift wealth can increase the estate tax exposure drastically. So how do you avoid that? Well, you implement annual gifting strategies in family wealth planning. And ideally, you're going to want to get your CPA and for sure your estate planning attorney involved. Occasionally a tax planning attorney, but frankly, that I would say that's for like the way up there's. Most people, you've got your estate attorney, you've got your certified financial planner, you've got your CPA, you're going to be taken care of. So if we wrapped all of this episode up, because we went over a lot with a big picture across all stages of wealth, the 3 biggest tax themes are, number 1, using the wrong type of accounts. Number 2, ignoring future tax brackets. And number 3, failing to plan withdrawals strategically. The households that build the most after-tax wealth are those that practice lifetime tax planning rather than annual tax preparation. And I've said this so many times over the years, and I'm going to keep saying it. Other than investing in yourself, the greatest investment that you can guarantee is not an investment. It is the taxes you avoid. So that does it for this loaded episode today. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional. the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Frey-Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Stock investing includes risks including fluctuating prices and loss of principal. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk including potential loss of principal. Before investing, carefully consider an exchange fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. A Roth IRA offers tax deferral on any earnings in the account. Qualified withdrawals of earnings from the account are tax-free. Withdrawals of earnings prior to age 59 and a half or prior to the account being open for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59 and a half may also be subject to a 10% penalty tax. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. Distributions of principal from a Roth 401k are tax-free. Any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with the Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. The information provided is based on current laws, which are subject to change at any time. Capitalize Your Finances is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Christopher Panayiotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning.